Well, what we're going to move on to right now is an area that is also near and dear to my heart, and that is the lending space. Our organization began in the lending space. We had our first peer-to-peer lending conference here in London in 2014. And so I'm very interested in innovation in lending. And so we're going to bring up two people who are representing companies that are doing interesting, innovative things in the lending space. So please join me and welcome Aaron and Seraphim. If you want to come up on stage, that would be great. Here we go. Thank you. Look. Okay, so, and you're even sitting in the right spot. That's great. So, well, let's just do quick intros. Aaron, why don't you just tell us a little bit of background and what you're doing in the lending space.
Yeah, sure. So I'm a senior credit manager at Warbler Labs, which is the team that's building the Goldfinch protocol. Goldfinch does real-world asset DeFi. What we do is we raise USDC on chain and then do private loans to businesses in the real world that have nothing to do with crypto, with all the kind of documents that you would have in a normal private debt deal, all the securities you would have off-chain, with the only difference being that we're raising the money on-chain.
Hey, I'm Seraphim. I represent Euler Finance. So we are DeFi protocols similar to Goldfinch, only that you over-collateralize whenever you borrow. And people primarily really use it as a decentralized prime brokerage. Like you put in USDC and you create a basis trade on, let's say, staked ETH versus ETH. So people kind of use it as a prime brokerage to get yield opportunities and leverage up margin trade. It's permissionless, which means you don't need KYC, AML, because you over-collateralize. So, yeah.
Okay, so then maybe I want to dig into each of your areas here, because it is really interesting and using technology that didn't exist just a few years back. So maybe, Aaron, why don't we just talk a little bit about your use cases? Your use cases is interesting because you're bridging two worlds, right? You're raising money in one world and lending it out in another world, in what we will call the regular world, I guess. So tell us a little bit about how that works and why you chose to do that, because there's certainly, if you're lending money in the real world, you don't need to go out to the Web3 world to do that.
Yeah, no, it's a good point. We just think that there's several things about DeFi and crypto and blockchain technology that really makes this a better model. So, for example, we basically feel like the debt supply chain in the real world has become kind of bloated and fee extractive. Think about this, right? You're a pensioner, you give money to your pension fund, the pension fund gives money to a fund of funds, the fund of funds invests in a fund, that fund sets up an offshore tax optimal fund, they have to take fees in order to pay their OPEX, and the borrower has to pay legal fees. Meanwhile, we just take the borrower, put them on chain, bring retail investors or institutional investors, put them on the other side, borrowers pay zero fees. And so when I describe this product to borrowers off-chain, they're like, wow, you're able to execute very quickly as well as give them the right investors. And so on that second point, I think the other benefit of blockchain is that the traditional finance system has kind of created these funnels for where money should go. Everyone invests in ETFs and government bonds and things that are rated, but all these regulations have not really allowed capital to go to true economic activities. Whereas people in crypto are looking for very high yields. They're looking to kind of break the existing financial system and start at a first principles basis looking at these debt deals. And so crypto investors are actually incredibly well placed to do the kind of investments in the real world in assets like fintechs, which are underserved by banks.
Right. Okay, and just before we move on, who are the typical borrowers? Are they fintechs? I mean, where are you focusing?
Yeah, so our credit team are traditional finance, fintech investors, debt investors. So we have started with that. So we're either lending directly to fintechs that are more like household name unicorn fintechs that people on chain can start to understand. And then majority of our borrowers are actually fintech credit funds. So we're putting money into safe hands who can then originate several more deals, which also allows for diversification of exposure.
Right, okay. Okay, so Seraphim, let's turn to you, and I'd like you sort of to go through in layman's terms the sort of how your platform works, and maybe you can just explain the different pieces along the way.
Sure, yeah. So the entire thing is obviously automated by smart contracts, and the way it works is you lend, let's say, Ethereum or whatever crypto asset you've got that is collateral on Euler, and you can borrow things against it depending what you borrow. Let's say you want to borrow USDC or you want to borrow W Bitcoin. You do these things typically to margin trade or to put on some sort of leverage, some sort of a leveraged position. So why is that cool? Why would you automate that with smart contracts? Because instead of having people working on the trading desk, it's done entirely by smart contracts. There's absolutely no maintenance. There's no involvement from the team. For instance, activation of the market happens instantly. Like if you want to lend or borrow any market in crypto, you could just pay a bit of gas fee, activate that market, and it works. So unlike a trading desk where you have to get feedback, somebody has to create a market. It's a kind of a logged, it's a process. Just happens a lot faster, a lot cheaper, and people actually use it to put on trades.
So then you're dealing with, professional investors, institutional investors primarily, or who are actually putting on these trades?
So anyone can use it in DeFi, but most guys are, well-capitalized traders, some traditional, some more DeFi, more degen guys, some whales, just one-man operations,
Right.
Guys like Jump, Alameda, Wintermute, or like just big guys, yeah.
Right, okay. Then how was it, I'm curious how this year has been for you with, obviously you have over-collateralized lending, but I imagine you had margin calls throughout the year as the price of digital assets went down like 2/3. How was that process?
Yeah, I mean, I don't know why. I think we're lucky a bit. Like, liquidity's been growing the entire year. It's actually up now to about 300 million TVL or so. The activity is quite good. Like, people actually use this for trading. One of the reasons for this entire volatility was the price of staked ETH, like an interest-bearing version of Ethereum, went down below like 1. And there was a lot of volatility around it, and guys like Celsius were affected by it. And a lot of people actually used Euler to trade against that in a way, so that created lots of activity. The pricing worked fine. The liquidations actually worked extremely well. So anyone can run liquidations in DeFi and Euler too. So if someone, let's say over-leverage staked ETH versus ETH, and staked ETH price goes down, anyone can walk in and say, I'm going to liquidate you for a little fee. And that process has been pretty seamless. So it's worked remarkably well. If it didn't work out well, I stopped doing DeFi, to be fair. But it worked. So.
Right, and I imagine, because obviously a lot of the blow-ups this year in the I guess they're more centralized lenders didn't work well, right? There's been more than a couple of companies that are going out of business. I guess maybe the reason yours works well is because you're if everything just gets liquidated, if they can't make the margin call, then you liquidate them out. I mean, how come yours works well?
I don't want to make it sound like DeFi is always better than CeFi. So there's part of it where, because it's smart contract based, because it's transparent, it works better. And you over-collateralize, obviously, and the collateral assets are pretty liquid assets. So if you had something extremely illiquid as collateral, like UST, the Terra stablecoin, right? As a liquidator, what you do is I take on your position, I repay your debt, I take on your collateral, and I sell that collateral on the market.
Right.
If the market is extremely liquid and I can't sell that collateral, it's not economic for me, so I'm not going to do it. So that relies, obviously, on good collateral choices in the market. So it's the same TradFi things as DeFi. The point is, though, it's extremely transparent. And anyone can participate in liquidations, which is why they work. It's a very competitive market. But also, I think the reason is that DeFi doesn't have as much leverage, I suppose, as centralized finance. Like, the leverage ratios are not so high that they're that dangerous,
Right.
So I think on average it's better. If you actually compared them and had the same leverage ratios, DeFi would still perform really well. But realistically, DeFi just doesn't have that kind of leverage you have in CeFi, where you can do anything.
Right. So Aaron, what about you? Because you are doing unsecured lending, right, to these credit funds and what have you. I mean, tell us about how you're doing that.
Yeah, it's funny because in the real world, we are over-collateralized. We're known as senior secured, over-collateralized lending, but we're collateralized with things off-chain. So when people are talking in DeFi terms, they mean collateral that is crypto collateral, instantly liquidating.
Right.
But we provide money to these fintechs or these credit funds, they top it up with some equity, they go originate loans, and we have all of those loans as security, and in some cases also have security over their
so
bank
really
accounts.
it is secured lending.
It is secured lending, but I try and tell people that in crypto, and they're like, you're lying to me. But in terms of like what happened during the crisis for us is this was the best proof of our idea that you want uncorrelated risk from crypto for crypto investors. I call up our borrowers after the crash and being like, oh, just checking everything's okay. And they were like, there was a crypto crash? Like, what's 3AC? And I'm like, amazing. They're just out there originating their loans in emerging markets. And so from our perspective, we just believe that that uncorrelated exposure is really a good benefit of our DeFi protocol. And
so can you tell us a little bit about the capital that you are getting? Is it stable coins? I mean, what is it? What are you getting, and how does the capital actually flow?
Yeah, great question. So we only accept USDC. There's no Bitcoin, Ethereum, or anything like that. We take USDC, we lend out USDC. And what the borrower will see is just a single coupon. The way that we do it on chain, though, which is another cool thing about blockchain, is the composability, is we take capital into our senior pool, which is just a unified senior pool that has diversified exposure over all the different deals and first loss protection in all of those deals. And then we also have junior capital that is deal specific and is the first loss capital where people have to come, underwrite, and say, I really believe I'm willing to take first loss capital in this deal. We put those two things together, make it a single coupon loan, and then deposit it into the people's wallet. And so in terms of who the investors are, we actually started the protocol as only accepting non-US retail money. And so our average ticket size is between $1,000 and $5,000.
Wow.
So retail investors are getting access to these private fintech debt deals that are usually basically cordoned off by all of the fintech credit funds in the traditional finance world. And we've been able to scale from $1 million AUM to 100 million AUM in 1 year based on these $1,000 tickets, which in a traditional finance sense is just like mind-blowing.
So is this all done through the Goldfinch protocol?
Yes.
Right? So if you're, if just an individual in the audience is interested, how would they actually go about getting involved?
app.goldfinch.finance, connect your wallet. You have to go through a KYC process, and then when that happens, we issue an NFT that says you have passed this KYC process, and you have to have that NFT in your wallet to interact with us.
Right.
But beyond that, just a couple clicks, and then you can be invested in these pools.
Okay, cool. So then, Seraphim, back to you. I mean, what are the terms of these loans? What interest rates are you getting? How long the duration are you talking about?
Yeah, so these are variable rates, which means if I borrow USDC, I put up Ethereum, I can keep that as long as I want, unless I get liquidated. And
so is this an indefinite term?
Indefinite, yeah. And basically the interest rate updates every single block, so it changes. Right. Yeah. So, yeah.
So can you give me what's the example? What's the interest rate like roughly right now?
If you lend, if you lend, let's say Tether, I think it's about 2%. If you lend ETH, it's quite low. I think it's like 2% too, relatively fine. Wrap staked ETH is like 6% if you lend it. That includes the reward from staking. So, yeah.
Okay, that's pretty low.
Oh, it's
considering where interest rates are going and where they're heading.
That's a great topic because basically, if you look at DeFi and CeFi, the interest rates were quite attractive in DeFi until recently, when in traditional finance short-term rates went up, and the reason is that DeFi interest rates are largely related to leverage in the system. People borrow, like I want to borrow some token, and I do that basically in order to get leverage on this, and that's what drives interest rates higher. The moment that people don't have desire to leverage up to get to engage in risk, they don't leverage up and the interest rates go down. So it's largely a function of this, really, at this point.
Interesting.
So that's why they decoupled, really.
Okay. So we have the Q&A QR code if you want to ask a question. We have one coming in here. So who audits Euler and Goldfish.
Yeah, there's auditing firms in the smart contract space that kind of, you can't rely only on them, obviously, but it's a good thing to do. There are about 6 audits. One of them is Sherlock. They actually underwrote like $10 million worth of TVL on this year, Holborn, Certora, so a bunch of firms.
Yeah, we have similar firms do our audits on the protocol side of things. I'm not a dev, so I don't know the names of them.
Right.
But the other thing for us is that we have to do real-world audits. So we require the same KYC process for investors for borrowers to go through. Make sure this borrower is a real company. They're not just going to take the money and run.
Right. And for you guys, like KYC is not an issue, right? Because it's over collateralized. You're not doing KYC at all?
No.
No. Okay. Interesting. So then, this was actually my next question. What are the risks of default here? What are the risks that people aren't going to get their money back?
Yeah, so risk is a big topic. So there's a couple of things that can go wrong. Let's say the collateral asset is very liquid and the pricing is easy to manipulate. I could deposit, let's say, Ethereum, and let's assume Ethereum has very low liquidity. I could just pump the price by 1 billion% and borrow an inflated amount of USDC or Tether and just run away with it. And that basically means that whoever deposited USDC or Tether, they lose money.
That's what happened to like Mango, right?
That's what happened on Mango, because the asset they used as collateral was their own token, which was quite illiquid. So they just pumped the price, borrowed whatever it is against it, and stole the money.
And it wasn't actually illegal what they did, because they just...
No, it was just a mistake. It was just a mistake, basically, to list something as illiquid as that as collateral.
Right.
It's the same thing as TradFi. You can't have illiquid collateral no matter what you do. It's like physics a bit. I don't know if you can do it. But second is, let's say you can... if a borrowed asset is illiquid, you could maybe collapse the pricing of it to almost zero. You lend 1 ETH. You borrow all these assets that supposedly trade at almost zero, and then you take these assets and sell them on a decent exchange at a decent price. And that way, it's more isolated, but you can steal money that way. So the lenders of those assets get screwed. So you have to make sure that the assets have decent liquidity, decent pricing. Without it, you end up with bad debt. And when bad debt occurs on Euler, let's say, there's a reserve fund that accrues every day from activity. So part of the interest paid to suppliers actually gets siphoned off into this reserve fund, and it's supposed to backstop these kind of situations. But there's nothing you can do if the collateral is bad, so you can't list crappy assets as collateral.
Right. Yeah. So just before you go, so you have limits on the type of collateral that
so it's governance driven. People have Euler tokens vote on what is collateral, what's not. There's debates going on and everything. It's kind of Euler's a DAO, so it's not like one person decides what is collateral. There's like a big conversation going on, and
so it could be theoretically possible for someone to okay a collateral that actually is not very liquid and end up.
It could be, but most of the token holders are like well-known serious VCs at the moment that would look very stupid if they allow something like that to happen. So their reputation's on the line, so they're not going to do it. Yeah.
Okay, so Aaron, let's talk about risk and default.
Yeah, so we're kind of on the opposite side. So with normal DeFi and what Euler does, it's mainly market risk, liquidity risk that you're focused on. For us, it's counterparty and credit risk.
Right.
We are trying to take on what most finance is, which is actually underwriting and choosing which borrowers are creditworthy. And so for us, we've started with a team of 4 credit people. I'm one of them. I make sure I interact with the borrowers, make sure they offer the investors the right data rooms. I read all their legal documents. We also have expertise doing this in the traditional finance world. And so early on, we're a decentralized protocol, but early on, we're trying to do our very best to make sure we're selecting the right people and also have that credit fund layer so that they are doing additional diligence and providing additional equity capital to provide that buffer. And so really we're taking on credit risk. And you need to be able to underwrite. It's a new thing for crypto. I think people are just getting caught up now. But so far, with our $120 million of loans, we've had 0 defaults. 10 to 12 of those loans have already fully repaid principal. So it's taking on the challenge of credit risk and looking it in the eye and making sure that you're investing in the right things.
So what are the typical interest rates and terms of the loan?
Yeah, so our borrowers, the last 4 loans we did, our borrowers are paying 10% in USD or USDC. And we bifurcate that. Our senior pool gets 7% from that, and our junior pool gets 17%. And then on top of that, we layer about the same amount of governance rewards. So our senior pool right now, if you include our GFI token rewards, 15%, junior pool is like 32%.
Okay.
From a deal that is a 10% coupon. And you
Right.
can trace every single one of those dollars back to someone repaying it. And so basically giving people Goldfinch warrants through the GFI token, as well as splitting the risk into 2 tranches, gives you composability as well as the riskiness that people are actually interested in.
And you're also, I just want to go back, like with the, like you said, you're doing it the credit fund, so you're as I said, it's secured to some extent there. And then what about with the fintechs? Is that fintech lending platforms, you're securing it on the portfolio of the loans?
Exactly. And so it's the same thing with the credit funds, right? We're secured against those end loans and that end security, and the same thing with the fintechs. We require, LTVs of around 80%, and so they have to contribute about 20% of equity, and we have an over-collateralized book of MSME loans or asset finance loans or consumer loans, whatever it may be. But every single deal we have is over-collateralized.
And who is, like you talked about, you're open to individuals. You said you started out saying anyone outside the US. Was that, where are you, what are you doing now?
We only accepted non-US retail to start, and then about 6 months ago, we accepted US accredited investors as well as international accredited investors. So now the only person we won't take is US retail.
Okay.
Because SEC, we're a little scared.
Yeah. That's fair enough. That's fair enough. So what are the risks of the pools defaulting? Actually, we covered that one, right? Yeah, so how do you measure risk and perform underwriting for borrowers in emerging markets? Places where traditional credit scoring isn't available. Where are you actually, where are your borrowers? Are they here in the UK or where are they?
No, so our borrowers are primarily in emerging markets, which I think why this question has come up.
Right.
We have about 20% exposure to the US, but everything else is spread across 25 emerging markets in Latin America, Africa, Asia, all across the world. And so you do have to have specific underwriting experience to be able to choose these borrowers. I was born and grew up in Indonesia. Our CIO is from Ethiopia. Our other credit analyst is from Nigeria. We all have experience underwriting these risks in emerging markets, but it is quite a specialist underwriting capability.
Yeah.
And we'll plan to expand into new asset classes where there'll be other types of people. We just hired someone in the US. Hopefully we're expanding into like middle market buyout in the US. So over time, it won't be our team who's doing that, but we'll be having DAOs or other underwriters who want to come and help the protocol write credit reports and do those kind of things to inform investors as much as possible.
Right. Interesting. Really interesting. So then, in closing, then, let's just talk. I'd love to hear from both of you. What are the growth drivers of your business, and what is actually limiting your growth? Seraphim, why don't you go?
Well, generally, there's not so much money in crypto, to be fair. There was a lot of retail involvement a few months ago, but that dried out. Essentially, DeFi is 20, 30 guys that sold, and now they use DeFi as their prime brokerage of sorts. So there needs to be more inflows. First, the asset prices should go up, but also new inflows. So yeah, I think, I'll be honest, you just need another bull market to get people excited. That's the only way. I'm not going to lie. The inflows are not going to come unless there's more excitement. That probably needs something more than DeFi, like an actual use case, because DeFi is this great bank, but banking for what? And people are trying to build things like on-chain royalties, which is super exciting, but it's quite early stage, or financing real things like Goldfinch, which are actually doing something extremely cool here. So once these real-life use cases start to become a thing, then DeFi can be exciting again, because so far we kind of built I like to make the analogy that we are driving on a highway, and there's no bridge. So somebody has to build that bridge. And that bridge is...
Quickly.
Yeah, quickly, because what we're doing, right? So it has to be some on-chain royalties, some gaming, metaverse environment, and DeFi hopefully comes in to financialize these things. So,
Right.
I mean, I'm just honest.
Yeah, for us, the growth driver is really that, exactly what you were saying, right? DeFi right now is 95%, if not 99%, crypto-backed, no credit risk, auto-liquidating loans. The equivalent in traditional finance is equity-based financing, which accounts for 1% of credit.
Right.
There is 99% white space, and there is 3 or 4 DeFi real-world asset protocols. So we're just trying to bring all of that credit on chain. In terms of the challenges, bear market is tough, and I just think it's a bear market in credit markets as well. It's hard to price deals right now. So we need that liquidity to come back, and we also need to figure out the right balance of having crypto pro institutions or crypto whales or whoever else providing liquidity versus traditional finance people. On this side, people want 150% APR and immediate liquidity, so our 30% loan seems bad, whereas I say 30% to a traditional finance investor, and they're like, oh, this is crypto, this must be a scam.
Yeah,
like,
exactly.
How do you get that? So I think just making that balance, as well as just making sure there's a bull market again in the future is what's going to spur our growth.
Right. Okay, well, really, really interesting stuff what you guys are doing. Thank you so much for joining us here today. Give them a hand.
Thank you.
Thank you.